Good morning, everyone. This is Ben Ryan. Welcome to the Hedgeye Morning Macro Show for Friday, July 10th, 2015. Before I hand it over to Keith this morning, I'll touch on our asset allocation changes from yesterday. Cash was increased to 52% from 49%. U.S. equity exposure was held flat at 4%. International equity exposure was reduced to 8% from 9%. Commodity exposure was also reduced to 2% from 3%. Foreign exchange was taken up to 6% from 5%. And fixed income exposure was reduced to 28% from 30%. With that, take it away, Keith.
Thanks, Ben. It's good to be back in the office here after a couple days seeing clients. You look at what's happening there on the asset allocation. For those of you that are new to the show, you look at it in rate of change terms. So what you'll note from our process perspective is that all that really matters is the rate of change in both our forecast, and again, growth and inflation, our risk management, which is of course nonlinear, and then the movement. So again, what we do every day is in rate of change. So that's why we're showing you positive or negative day over day. So again, we've been getting more negative on commodities week over week, day over day, as this stronger dollar has started to manifest. So again, on an up euro move, down dollar today, we would be fading that, and that's a big call to make in and of itself. I'll get into that. I'm going to go first through the top three things, which are pretty much a derivative of that. Number one is going to be the euro versus the dollar, of course, which is the number one thing driving a lot of things in macro. Number two, the oil trade and or the commodity trade, which is driven by the euro trade. And then finally, I'm going to address the China story, which is, of course, becoming just, I just say a joy to watch. Just a joy. Big smile for that. First, let's go to the euro. So let's go to the wood. I mean, look. If you use the risk range process, you're going to be in a much better position. So again, what I mean by that, for those of you that are new, is that you want to be making purchases or covers, buys and covers and purchases at the low end of the range, and you want to be making sales and short sales at the top end of the range. So again, this is what you did in U.S. equities yesterday. When you went to the top end of the risk range in the Hedgeye process, we faded there like a flower all the way back down to the low end of the range by the close. So again, what you need for that is a risk range, and you need an accurate risk range. So again, that's what you get from us. Now, the risk range for the euro is 109 to 112. So again, at the low end of the euro's risk range, which it hit, you're going to make a series of decisions that are high probability. And once we get to 112, we're at 111 right now. The euro's up actually a full % this morning, which for a currency is a big move, not only, but it's not a very newsy move. And what happens after this? So let's just say that we've for the upteenth time in the last 6 years, we've solved all of Greece's problems of insolvency, but maybe not. And we're at the top end of the range. So let's say at some point next week, the euro, or at some point today for that matter, or on Monday, we're going to have euro 112. At that spot is where you short commodities. You short the inverse of that because, of course, up euro equals down dollar equals up commodities, up oil. So that's what we're going to, again, we're just trying to get you into how to practically manage the macro risk that is, again, nonlinear, but we have a process to incorporate the nonlinearity of it all. So again, from us, you're not going to get somebody selling you books or selling you Nostradamus or selling you, again, a lot of people are much smarter than me and they can do that. All I wrote a book about was getting fired. I mean, if you want to read that, that's just more of a reality type of a story. But the reality for me is that I need to change my mind each and every day. Telling you that this is going to happen over the course of time, okay, that's great. Okay, that's great. I can tell you what I think is going to happen, but what it is that I do every day is why you should be paying to listen to this, which is, again, changing my mind within the risk range and looking at a series of immediate-term catalysts within the intermediate and long-term range. So again, that's called being multi-factor and multi-duration. Again, looking at the immediate term, intermediate term, long term. And again, that's an important framework to have. That is our process. We will not apologize for it. We are quite proud of it. Some people call it voodoo. I think that's because they're a little lazy and they wake up having nothing else that they can call it because they may not understand it. And I wouldn't understand it either if I was sitting on my couch all day long or in my basement for that matter. Did I just say that? I had to. If you look at it for what it is, oil. Was I talking about oil? So what's the risk range on oil? It's widening. Okay, so another thing to think about in the top three things today is I'm doing a lot of process here because I haven't been here for a couple days. But again, is to think about, is the range widening or is it compressing? When a range is widening, it's not like parting of the seas. It's just giving you a leading indicator of volatility rising. So again, this is not a secret. This happened obviously in the currency move first, then it happened into the commodity move. One front ran the other. So again, all of FIC, which includes foreign currencies, commodities, and currency trading, That really moved because the euro risk range widened out, and now we have a wide risk range for oil. So the current risk range this morning in oil is 49.62. I'm talking about WTI, 49.62, write it down, 55.29. Now again, that's what we would consider the probable range. Okay, the probable range, in other words, if you go to, so why would you short oil here? And why you wouldn't short oil here? It's not at the top end of the range yet. What would get it to the top end of the range? Euro 112. So again, that's how you use the process. And again, I'm not telling you that it's perfect. I'm telling you that this is the pros. And when I can get a high probability pitch, if the count is 3-1, and I know it's going to be a fastball, that's what I want to hit. I don't want to get up in the morning and write a book. I want to get into the slot and look for that pitch. So again, sometimes you have to wait for the pitch. Sometimes you have to wait for 55 oil. Sometimes you have to wait for Euro 112. I hope we're clear on this. If we're not, let's take some questions because it's a very important process point that I'm trying to make. Now, finally on China, I can stop talking process for a second because their process is just, at this point, to either lop your fingers off if you're a Chinese broker with a sell order, or at some point scare the living daylights out of anybody else who might have a sell order and halt everything else in the meantime. So if you read the mainstream media this morning, if you're driving and listening to Bloomberg Radio, I've been listening my whole life. Was a great show. It's just a little suspect these days with the politics of it all. But again, if I'm just looking at my process and listening to the blah, 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 markets are doing this on blah, 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 right? That's what it sounds like. It's like Charlie Brown. Again, if you're me, a math guy, and with his own research team, you're sitting there just blah, 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 and all they're saying is, well, China's up. It's great news for China up. And I'm like, Charlie, they used to have Charlie Pellet, by the way, on Bloomberg. I love Charlie Pellet, love Bloomberg Radio. Charlie, what's up? There are over 1,400 stocks in China are halted still. So what part of the index are we talking about? The non-halt? The non-halt had a big move. But where is that move within the context of the multi-duration framework? So again, instead of saying, okay, I think it was, Mobius is out there. People who are in the business of being long China, guess what? And this is a real super secret. I don't want to reveal all the buy-side secrets right here today. But the secret about the guys who are in the business of being long China are bullish on China. Get that. Can you imagine that? Jim Rogers, Goldman Sachs, and Mark Mobius are all telling you to buy it after they already bought it. I mean, this is what it is. But if you bought it a month ago, you're still down 24% on the Shanghai comp. That's point number one. That's the immediate term trade. So we qualify that as a crash, greater than a 20% decline. So you're still in crash mode, and they haven't taken out the halts. And then you look out at multiple durations. So I look at the tail risk line for the Shanghai Composite Index, which at this point, write it down, 42.75. So unless you can get above 42.75, every move in China is just wah, 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 wah. I don't care. I don't care what you tell me. I was not born to this world to be told what to think from some Chinese dude who's going to threaten my buddy broker in China, which I don't yet have. I might get one. Threaten his, Jason Pierre-Paul. I mean, there's a lot going on out there. I mean, come on. Okay, so these are your top three things. I hope you're good and ready for some more stuff here. Let's just do some risk ranges before I stop and take some questions. Risk range, again, we spent some time on the risk range this morning. The risk range for the S&P 500, 2035 on the downside, and we have 2087 on the upside. Yesterday, I had 2075 on the upside. If you don't want to listen to me or listen to, like I think a lot of people who either love me or loathe me might say that I'm the wah, wah, wah. I'm a talker. I like to talk. What else am I supposed to do? I mean, the reality is that if you don't want to listen to me talk, just pay for the daily trading ranges that we send you. There are 12 of them, and then you just look at the range. You're going to make very good decisions when you have 3-1 counts. I can guarantee you that. Sell the top end of the range, buy the low end of the range. If you sold the top end of the range yesterday in the S&P 500, you crushed it. If you sell the top end of the range today, if you get 2087, that's the point. You got to wait for the pitch. I don't know if you're going to get 2087, but you'd have to actually get above 2086, which is trend resistance, for that to matter to me at all as well. And by the way, I think that once we get through all this, the upside down of this is, of course, that you'd have to break down, which is volatility. Volatility, let's just give you the level first. 1559 is support, 21.08 is resistance, series of higher lows and higher highs within a bullish formation. Another key thing to say there, bullish formation. I don't know if the team could put that up in terms of how it's defined. Bullish formation in the hedge eye process means it's bullish trade, trend, and tail. So we have a multiple duration process, and it's bullish on all three durations. So that is called green lights. And again, that's where you have volatility. It's been that way for quite some time. So that's why once we get out of the Greece and the China and whatever else you want to tell me, that stocks should go up on down earnings, tell me whatever, tell me. Just tell me. It's different this time. You know, one of my top competitors was saying we're going to have global growth and reflation, and then all of a sudden this week he's like, no, I don't think that anymore. I was kind of kidding. Here we are. You know, I mean, every day I was on the road for 2 weeks, dude, and you're telling everyone that right before I come into the room. I had to refute your whole process, and now you got my process. What's up with that? This is why a buy-sider would always get a little frustrated with the sell side of it all. Because again, there's no process in that. There's no process in buying high and selling low. There's none. I mean, it's called momentum. If you want to chase momentum, pay for somebody else's over-the-top pay TV subscription. If you look at the trend in volatility, why am I going off on this? Because the S&P 500, unless it gets above its trend, and unless any of the fundamentals change, I mean, just talking about the quantitative setup, and the VIX would have to break like 14.5 on the downside, by the way. What is the next catalyst? We've gone through all the wah. Now, the next catalyst is this, again, and this is a secret. Please do not tell the sell side or mainstream media about this, but the catalyst next is this really unique thing called growth. And you cannot print or centrally plan growth. You most certainly can't. Particularly when we're in a secular stagnation call, we got demographic cliffs across the world. You can't. So the number one call that we've been making for a long time now is not going to change. I mean, you can give me a lot of crisis. You can pay me on the crisis. You can make our Alibaba short look fantastic when the four-finger Johnnies are in business in China. I don't care. What I care about from here on in is growth. If we're right on growth, you're going to be seeing more panic and more central planning. And at some point, if we're not already in that point, I would argue this week, and Bob Rich captured this appropriately, and maybe we have the cartoon on going from halt. Actually, we didn't go from halt. I'm going to, you know, if you don't make the cartoon, sometimes you mess up the cartoon. We went from bad to halt, okay? So that's bad. I think that's pretty bad. Personally, I think that's pretty bad. So if we continue, if the tail wagging the dog here is growth slowing, we're going to go, we've already gone from bad to halt. So I guess we're going to go halt. Let's just change the politician, halt, you know, move this guy in, move this guy out. This is going to be a really interesting exercise to watch. And at a bare minimum, you'd be betting on a volatile one. So again, embrace the volatility, sell at the high end of the range, buy at the low end of the range, and rinse and repeat. Tech, I just want to hit on tech on the sector studies because that's the really the only big call out yesterday was in an up tape. And don't forget, at one point, the S&P futures were up 27 handles. They're probably up that here this morning. They closed up 4 handles by the end of the day. But tech was actually down on the day. Now, what part of that has to do with Greece? I'm pretty sure nothing. But again, if you look at what's been happening underneath the hood, whether it's in Asia, which I can summarize as follows. If you don't have a central plan, your market didn't go up today. India, South Korea, look at those markets. Demand globally is slowing. Semiconductors, look at a chart of Intel. It was actually down before the market even had its intraday reversal. So again, you have a lot of problems out there in tech, not the least of which are called the advertising cycle, and a lot of these what I'll call social media tech stocks, which really have ad cycles within it. And all due respect to all the 22 to 25-year-olds that are running companies, I used to be your age, you've never seen an advertising cycle. So your cycle guy is right here. And I want you to answer to your board on what you think happens in a down advertising cycle, no matter how cool the next app you have is. So again, these are problems that companies, the not so impressive ones like Yelp are obviously already having because the cycle is slowing, so their ad revenues are slowing. And if you sell advertising to companies who are slowing, I bet you your revenues are slowing. I'm a real thoughtful guy sometimes, I tell you. China or Asia already hit on it. Europe, I don't want to say anything else other than you're going to start to get some sell signals. The good news here, in timestamp terms, is that we don't have any European shorts. And I say that with a big smile because I was waiting for this. Of course they were going to save the Greeks. You know, we've told you this multiple times. There is no case for a Eurozone with no Greece, Portugal, Spain, and Italy. I mean, McFly, so why would you be short at the low end of the range when you know that? I wouldn't. Again, that's the process. So again, I'm thinking forward, thinking, okay, can they keep their banks closed for the entire summer? Probably not. So today, you're going to have what we would call a fantastic short selling opportunity. And no, Goldman Sachs has not called us yet to buy HedgeEye because that's a great way to sell risk management to clients. But again, why, if you have great buying opportunities, why don't you ever have great selling opportunities? Of course you do. and you will here in Europe today. So pick your pony. It's either going to be Spain or Germany, because those are the ones that have the highest consensus growth estimates. Look at Bloomberg consensus on German and Spanish GDP relative to the hedge eye model. So again, I want to be short contrarian options. Again, on up days at the top end of the range, not on capitulation at the low end of the range. That's where you cover. Again, so top end of the range for the German DAX, like to see it over 11,300 if you're looking for a number. And on the Spanish IBEX index, if you're looking for a level, it would have to be over 11,105. Now, I'm just a geek who writes these down every day of his life, and these are the levels. If you don't like them, too bad. If here we are, the rest of the world, according to Keith, is gold. I'm probably gonna get rid of gold on strength here today. Yeah, I'm gonna, I happily debate anybody on the world according to Keith. At least I've done my work. Here we are, gold. I'm not like married to gold. I'm not. We have gold on the long side. Probably taking it off here. Don't like your gold in a strong dollar environment, and neither does the market. But everybody knows that, because those of you who have risk managed the market in the deflationary period, which is of course from around this time last year to January, realized that being long gold, there was no positive to that religion. And in fact, you'd have the repent side of that. So I don't want to go through that personally. That's just me. 1175 is now resistance. Gold failed to get back above trend resistance, which is closer to 1214, and I obviously don't like that. If you're looking for a risk range on the 10-year bond yield, I think it was very clear on this earlier in the week. You don't buy bonds after they've moved from 255 to 225. That's called doing the opposite of what I just said throughout this little teach-in on the risk range. So again, hit the low end of the range. It wasn't magic. It literally hit the low end of a range, which is 218, and bounced. Okay, now what? Janet, you're up next. Have a nice speech in Cleveland today. Make sure to remind everyone that you're data dependent and that there's this firm in Stanford who's pretty good on the data relative to the consensus. So again, if you're front running the data, you're front running Janet, because Janet, unlike the Bernanke, is much more, shall I say, truthful about being data dependent. She's a big T crosser. She loves the I dots. She's big time bureaucrat, don't forget. And you need to play that to your advantage. So again, at 245 on the 10-year, that's the lower high of resistance. I would be a better buyer of bonds. At 220, you'd sell some that you bought at 245 to 255 last time. Again, think about the risk range when you think about your process. Away from that, we also made the only currency call we made this week is short the yen on strength. Hopefully you did that. The yen is down almost a full % this morning as well versus the dollar, and that has no immediate term support to 123.5-ish on the risk range. Again, you want to be selling yens at the high end of the range, and you want to be covering them at the low end of the range. Hopefully I've made my point clear, and I'm getting out right now on that and taking some questions, because the world according to Keith has gone on quite some time this morning. The world according to Evans, I love this guy. Chicago, Federal Reserve, Chuck Evans. Chicago, think Chicago. What does Chicago have? Do they have, what kind of markets or lobbies within the market are pushing a guy in Chicago? What do you think? what like commodities maybe? Do you think? Do you think Chucky?
Out at the Board of Trade.
We're not talking about Chuck Prince. The Chuck Prince of Chicago is Chuck Evans. So this guy's big time. Like if you're trying to sell people.
Actually, the Federal Reserve building's right next to the Board of Trade.
Oh yeah, yeah.
In Chicago.
Oh yeah.
Yeah.
So Evans comes out this morning, and I appreciate it because he said what we've been saying. I said I think we should delay a rate hike till the middle of 2016. Now, there's reasons for that, because everyone in his building and the building beside his building and everybody who's long commodities in Chicago is knocking on his door this week and last week. They don't like strong dollar. You know it. I know it. Rahm Emanuel knows it. You all know it. Let's take some questions. I'm getting myself into some trouble here.
Let's get to it. Beijing's intervention was absurd, but in all seriousness, would you risk being short given the political overlay?
Not yet. No position. Okay. There's yesterday afternoon we played golf with a great investor, and there are many great investors that we talk to, and they all have different styles. I think that's the point. Hopefully you can find people that can help you augment your style, and if you think you can do it all on your own, then good luck. I can't. But he made this very simple point. He's like, why do people feel like they have to trade every move? And we're kind of going back and forth, and he said, I think it's because they're sitting at their desk, and that's their job, is to do something.
It's probably why Warren Buffett lives in Omaha.
Right. Why would you do something in China right now? I mean, why? It's still in crash mode, first of all, so I don't find that interesting. If I see China failing at 42.75 on the Shanghai comp, there could be another epic short trade there to be made on the short side. Because like anything that goes down, Wall Street's all talking about the upside and not about why we're on the way to the downside. I mean, wake up, guys. There's two ways to risk manage a market. It's not always buy.
Okay, next one. Is your trend view, you answered this, is your trend view on all, but I think it's still important to ask, is your trend view on all commodities now bearish? So you're playing a range on the short side. What's the net exposure from the asset allocation?
Well, it's really hard on strong dollar correlations from a trend perspective, 90 days or more, to just come up with it. And this is where the smart guys will be much more thoughtful, maybe not much more accurate than me on this, to delineate on commodities. If we're going into the volatile period of correlation risk, I'm not going to be smart enough to pick what my nose or the commodity that stands out. I can tell you that if you need to be in commodities, long and short, I'd be long gold against short oil from the right levels. But that's about it. I mean, I don't look at anything and say, we've had some huge moves to the upside in the ag complex, actually, that look quite interesting on the short side.
Yeah, I agree.
There's a lot of things out there that we've had counter-trend reflation moves that you want to start to put the deflation trades back on.
Yeah.
If you look at all the underperformance out there in 2014, if you look at a fund that was flat, down, or sideways, they all missed the risk of deflation. And I think that that's still one of the biggest misunderstood risks that I see in the marketplace, is you have so many fundamental people who really discount the impact of the dollar on commodities and inflation expectations. There's a lot of different things that have inflation expectations, including levered debt. Don't forget, if you have deflation, that is the enemy of the debt. It's not the friend. You have obviously anything that's linked to currencies or countries that have, or currencies and commodities that have been net beneficiaries of down dollar. I mean, there's a lot to think about there.
Okay, this next question's from Theo Fleury.
Theo?
Yeah, he's on.
Like the actual Theo Fleury?
I think so. It says it's him. Can you please provide a scenario where the euro breaks 1.14? I am in the camp that the USD is headed to 120, but if the euro breaks 1.14.5, looks like the trend could break.
Yeah, I mean, well, our intermediate term trend line of resistance, Theo, is 114. So we're in both in good company with the short Canadian hockey guy thing and the view on that. So to see a 114 breakout of the euro towards 118, you'd have to see what we saw. Please, everyone, remember, why was the dollar breaking down and why was the euro breaking out? Because the Fed was pushing out the dots as U.S. economic data was weakening. Remember the March jobs report? Remember the most recent jobs report? That's 2 of the last 4 have been bad, and it's always bad at the end of the cycle on the turn. So again, the number one thing, I'll say this slowly, the number one thing to being short the euro as a risk is the Federal Reserve coming, to my view, now. Like saying, forget December, forget 2016, we're going to QE4, baby.
All right, next one. Based on your ad comments, would Facebook be a good short at some point soon?
Maybe. Obviously. I mean, how many stocks are never a good short? I mean, we've liked Starbucks for quite some time. I'm an addict. But in 2009, you could have bought that thing 800% lower. I mean, great company. I don't think the coffee changed. In fact, I was spending more time there because we were building Hedgeye. I didn't have an office, for God's sakes. And it was free internet connection, all these things. I was thinking about, wow, it's great food. It's free rent. Now,
there isn't any free rent.
Oh, Facebook. Whoa. Apple. Whoa. Never going down. Good companies.
All right, what's your take on the NYSE shutdown? No explanation. Last time this happened, August 2013, and there's no clarity really here.
Well, I couldn't say this on Fox yesterday. I called it the CYA factor, but I could say it here because nobody's going to fire me. CYA is cover your ass, okay? So if you look at what a lot of these mismanaged or old wall, as I'll say, companies really have here, they have a cover your ass problem. They think about themselves first. If you didn't know, now you know. And when something like that happens, let's just say that there was some remote chance, some probability greater than 0, that it was a hack or some version of a hack or a cyber attack, and they didn't know how to answer the question. The first thing they do is they go underneath they go in hiding. Dick Grasso would have been out there every 5, 10, 15 minutes telling you exactly what was going on. And back then, there weren't cyber attacks of that that couldn't be of that kind of an impact. So I don't think that, obviously, Well, I shouldn't say it's obvious, actually. I don't know what it was. And actually, as this guy on the golf course said to me yesterday, very seasoned guy, been around for a while, successful hedge fund guy on Wall Street. He said, you know what, Keith? If it was a hack, I don't want to know.
Yeah.
Can you afford to know that was a hack?
Yeah, it would scare you, for sure.
Scare you.
Yeah.
You know, and then all these guys are like, oh, I don't know, I could still trade on the side over here. Look at all the stuff I did in the machine. It's like, take your machine and throw it out.
It's scary stuff.
The New York Stock Exchange, I don't care if they have 5% of total volume. The New York Stock Exchange is it is a pillar of American capitalism. If it is hackable, if it is in any way penetrable, and you got a bunch of old wall guys hanging out on the switch, that's a huge problem. So I actually hope, in my heart of hearts, I hope that to a degree they actually are lying. I agree. We're all out of this if that happened. If they lied, keep that lie going, guys, because we're all done, like dinner. Winner, winner, chicken dinner. Out.
All right, last question. If the broad market sells off more than 10%, would the Fed implement another round of QE?
Oh, yeah. Oh, yeah. That's the biggest catalyst, man. I mean, forget we talked about Chucky Evans, the Bullard. This guy is a beauty. He's so serious about his views, and I still can't. I was calculating. I'd have to give an update, but I think Bullard's been wrong 64% of the time on his growth and inflation forecast, but never in doubt. Very serious about his methodology, and it's like so bad. I mean, it's like I'm thinking way too much about other metaphors, but these people have no other thing to do other than to print and centrally plan if the market were to actually go down. That's the message of the week.
Arresting the cycle. Yeah.
You know, the only thing the U.S. hasn't done yet, which I would assume might even be the next big thing, is that we just start to go to the halts. You know, the non-cyber attack halts. I mean, of course they're going to come back. Of course. They'll do more. They'll tell you they can do more.
Yeah. Well, maybe they can just, if there is a drawdown, they can come out and say, well, we're more honest this time.
Yeah.
This was a cyber attack.
Oh, yeah. Well, if you explain it that way, then you can politically justify it.
Yeah.
You know,
all right. Thanks.
We have to halt. If we are now under growth attacks and cyber attacks, we must halt.
All right. Thanks, Keith. Thanks, everyone, for tuning in. Good luck out there today, and we will catch you back here on Monday, same time.